Welcome to the Asia Society. My name is Aalok Kanani. I'm the Chief Digital and Communications Officer here at the Asia Society, and it's my pleasure to welcome you to our Asia Executive Briefing. This event is part of a series of public programs and private briefings with economists, policymakers, and business leaders taking the pulse of Asia's dynamic economies. And today we're excited to be joined by Dr. Atsi Sheth. Her full bio is long and illustrious and available on our website, so I'll direct you there. But to be brief and highlight, Dr. Sheth is currently the Managing Director and Global Head of Credit Strategy and Research at Moody's Investor Services. And as of April 1st, she will be the Chief Credit Officer at Moody's. So let's start with the congratulations to you, Dr. Sheth.
Thank you very much.
Dr. Sheth is a leader in her field with a commanding view of what is going on in the global economy, and we're very grateful to have her here today. Before we begin, I'd like to make a few acknowledgments. First, thank you to the Columbia Business School's APEC Study Center for their partnership in presenting today's program. We look forward to more collaboration with Columbia Business School. I also want to thank all of you for being here, particularly our members in the audience. Our work here at Asia Society is possible thanks to you. If you are not yet a member, I would encourage you to visit our website at asiasociety.org. There you can also find out about our upcoming events like this one. Finally, a housekeeping announcement. If I could ask everyone to please make sure that your cell phones are silent. And a reminder that this program is on the record and a video of it will be posted online afterwards, so be aware of that. We encourage audience engagement, and we'll have Q&A at the end, so please have your questions ready. A microphone will be passed around. And with that, let's begin. So Dr. Sheth, today we're here to talk about a year of risk. So let's dive right into that very, very big topic head on. Looking at the year ahead and the global economic outlook, start with the highest priorities. What are the biggest events and economic trends you're observing? And how is that shaping the behavior of both governments and companies and the leaders?
Thanks for the question, and thank you first for having me and for you all for being here. I should say that in my career, Asia has been dominant in everything that I've done. I have a global role, and Asia has just become an increasing part of it. So it's particularly nice to be here today. The question, it's a very good one, and I'll preface my answer by telling you how I got to it. Every year, we at Moody's, as you all probably know, we rate thousands of debt issuers around the world. And there's a very diverse range of issuers. So that you have Japanese auto companies, a municipality in the Midwest, a French utility, all of that, thousands of issuers around the world that we rate. And what we have found over the years is that, yes, each of these debt issuers has very specific concerns. So their sort of credit profile is driven by their revenues, their profits, their investment profile. Their leadership worries about very company-specific things. But when you actually aggregate what the leadership of all these entities are worrying about, there are usually a few common factors. And so every year we do a bit of a poll where we ask our rating analysts around the world, and we have, again, more than 1,000, to sort of tell us what the debt issuers in their portfolio are thinking, the analysts, the CEOs, CFOs, et cetera, and what the analysts themselves are thinking. And then we ask our macroeconomists to say, well, what do you think is going to drive things like GDP rates, inflation, things like that? And we bring it together and we say, these are going to be the credit themes of the year. So with that long preface, I'll share what they told us last year and what I think is coming true so far this year. They said, look, in 2024, there's 4 things that are going to matter for the global economy, according to our sort of debt issuer views. One is the interest rate environment. And this isn't just about where the rates go this year, but the fact that we've come from a 10-year period pre-pandemic and then through the pandemic of exceptionally low rates to a fairly rapid increase in interest rates. And our own view at Moody's is that this year the Fed is going, I know the market has sort of gone up and down on this, but we think the Fed is going to cut rates in mid-year. So is the ECB, so are major central banks around the world. In fact, in Asia, that's already happening. So rates are going to be cut, but we may be moving to an interest rate environment that is a step change higher than the last decade and even before that. So that's something that people are thinking about. That how do you make economic decisions when your cost of capital will not go back to what it was a mere 3 years ago and for the decade before that? So that's number one. And I'm going to do an audience poll on this, so please do remember these. The second one that people told us is, besides interest rates adapting to structural changes that seem very far away when you describe them, but are actually, even though they're sort of long-term changes, every day the dial is moving, and three particular structural changes stood out to them. One was demographics. We all know that the world is aging, including in Asia, even though there are some very young populations in some countries. The world is aging, and that has ramifications for the economy. That, it has ramifications for the labor force, for consumption, for savings, for well-being in general. So that's number one. And even though it seems like, okay, aging is something that happens over a long time, if you look at the labor force and how it's shrinking, already in Japan, you've seen that happen, but it's happening elsewhere in the world too. That's sort of one dominant structural change that businesses and households have to deal with and policymakers have to deal with. Two, of course, is climate. Again, seems like, oh, that's a very long-term thing, but the physical climate risks are already with us in sort of drought and floods and things like that. But carbon transition, again, people think it's moving slowly. But, almost $2 trillion a year are spent on renewable energy investments. So it's not so far away. It's happening now. And the third, of course, is technology. And I think given your role, we'll be talking about technology a lot more. And here in technology, we think about digital technologies, including blockchain, which we think has very many applications beyond crypto. And then we think about AI, of course. And again, much broader than Gen AI. Of course, Gen AI is the price. So that was sort of the second thing. Rates is one. These big changes, businesses have to adapt to them or you lose. And then, in the context of these two things, people brought up polarization again and again. That the fact that within countries you have such divergent views and that sort of, middle consensus is ever harder to get means that your Overton window, when you can make policy, is getting narrower and narrower and sort of, sometimes not opening up at all. And this polarization within countries, polarization between countries, is making things difficult for business. It's making things difficult for people. So that's sort of one thing. And then the last thing that people talked about was, of course, policy and regulation. We are at a moment where climate policies, again, are having, the SEC disclosure rules, I don't know if you all follow that, but that was something that was sort of, very highly awaited, has been controversial. But beyond climate, financial regulation, here in the US, we talk about sort of the rise in non-bank finance and how to make sure that that doesn't become a systemic risk. There's everywhere a fear of technology, unregulated technology, and the damage that it can do to society and the economy. So regulation was sort of the fourth pillar. So those, Aalok, were the four things. And with that fairly long sort of answer, I'm going to actually turn it over to the audience, if that's okay with you.
Great.
And can I ask which of these four resonate with you the most in what you're doing? You have a question?
I would say that the biggest problem that humanity is facing is climate change. And as recently as a day or two in the New York Times was the article about the climate problem. And so as your global analysts have identified climate, and we have South America, one of our associates here just got back from Argentina, which is in severe drought, along with the Amazon and Chile. So one of my pet peeves is the fact that the Amazon rainforest has been decimated, cut down, particularly under the criminal Bolsonaro. And if you destroy the climate sinks, the Indonesia, Central Africa, and the Amazon. So what's your take on all those climate sinks being destroyed vis-a-vis climate change?
Sure. And if you don't mind, I'm going to do the audience poll first because I do want to hear from those gathered here, but I will address that. We do have a view on it. Climate, let's start with climate. Who thinks climate is the number one thing that resonated with them? Show of hands. Interest rates. And you can choose more than one if you like. Interest rates, the big structural shifts. Big structural shifts got a lot. Okay, so I think that's sort of trending as number one, and climate is certainly part of that. And then what was regulation? Polarization, yeah. Okay. So I can sense that these things resonate with you all, but clearly the structural shifts I thought was sort of the winner in the poll.
That's interesting.
Indeed. Yeah. Yeah, exactly.
So do you want to touch on the climate question?
Yeah, sure. So there's a couple of ways, and I'll sort of start off with how we approach the question, because you're undoubtedly correct that there are sort of climate sinks have been, sort of the forests that can absorb the carbon dioxide have been denuded. We think about it in two sort of main ways, because we think about it in the ways that it affects creditworthiness and sort of either of individual issuers or of sort of the society as a whole. One is the physical climate risks that are caused by the fact that the climate is changing. And here, the kind of debt issuers that are sort of most affected tend to be in emerging markets. So it is countries that are lower income that, as again, this audience well knows, most of them didn't contribute to the carbon emissions. And even the ones that are sort of called out for contributing to carbon emissions, on a per capita basis or a consumption basis, they're actually not emitting as much. They're manufacturing a lot or they're mining a lot and they're emitting because they're producing for the rest of the world. So these are countries, and this is well known, this is uncontroversial to say, that here are countries that have not sort of contributed to it, but are actually suffering from it. And we don't have financial solutions to mitigate this. So that's one thing that we think about. And here I'd bring up the role of multilateral development banks, which are trying to do more. And one of the sort of very interesting, and maybe this gets at your question, it won't address it fully, but one of the very interesting things that we've seen happening more recently is emerging markets that are blessed with a lot of natural resources are finding organizations from the Nature Conservancy to the World Bank to others who are creating instruments that are then packaged to sell to financial markets that are based on preservation of those natural resources. So for instance, Belize issued a sustainable bond where, again, based on the fact that you will sort of sustain your natural resources, you will protect them, and the sort of proceeds of the bond partly go to do that and partly go to do other things. So there are ways in which you can finance conservation, but I think the other thing that really needs sort of financing is actual mitigation of the impact of climate change that is already there, and that's one. The second way that we think about it is there are trillions and trillions of dollars in debt already issued by fossil fuel producers. Then their lenders, banks and others who have lent or bought equity in fossil fuel producers, have also issued trillions of dollars in debt. And if we are moving, given all the net zero pledges that are made, towards a transition away from carbon, the assets of fossil fuel producers and sort of the revenue streams of fossil fuel producers are going to be less and less valuable, and they have all this debt outstanding. And what are financial markets doing about that? That, again, is a question that I don't think there's an easy answer to. But I will say that the solution will not come primarily from the market. It does come from policy. And policy, of course, varies. I mean, you mentioned, in Brazil, depending on the administration, there could be more or less of sort of policy intention towards preservation. Here, we've seen the Inflation Reduction Act, the Infrastructure Act. The Inflation Reduction Act focuses much more on carbon transition than it does on physical climate risk. But I think policy is making actually a big difference here in the United States. We've seen renewables investment go up significantly thanks to what the Inflation Reduction Act has done. And again, an anecdote that perhaps this audience has heard before, Texas is one of the top destinations for renewables investment, not something that you would intuitively think, given its oil and gas background, but there you have it.
How much of that is due to Elon and him?
How much of it? It is beyond Elon. It is beyond the EVs. Okay. It is actually solar and wind. If you think about the geography of Texas, lends itself to solar and wind too.
You mentioned one of the big factors as polarization, which I think described in another way, especially polarization within countries and then among countries. Another way you can describe that, I think, is deglobalization, right? We're seeing globalization potentially reverse. Some people use the term reglobalization. How do you see that, and how is that impacting Asia in particular?
Yeah, and Asia is clearly one of the biggest contributors to globalization and one of the biggest beneficiaries. I started my career in New York in the late 90s, and one of the first things that sort of I was involved in was the Asian financial crisis at the time. And, it seemed like, in the decade before, Asia was this success story. And, for instance, this was sort of held up as a model for Latin America and elsewhere. And then you had this crisis. And people said, the story's over. But actually, in the 2 decades that followed, Asia grew immensely, and China particularly drove much of that growth. But all over Asia, you've seen so much happen. And I would say that elongation of supply chains that we saw in manufacturing, big part of that. So now your question on deglobalization, I will say that if you think about economic history, we've gone through periods where the world sort of trades more, comes together more, and then finds ways to actually break off trade relations and have Cold Wars or hot wars and things like that. So it's not new that there's an ebb and flow in global trade and investment. I will say that starting in the 90s with the end of the Cold War and Eastern Europe sort of coming into the broader global economy, starting in the 2000s with China becoming part of the WTO, there was this golden period for all of us, whether you were in manufacturing, services, finance, whether you were a migrant and an economic migrant, not just those were asylum seekers. It was a wonderful period, golden period of peace. And in fact, I will tell you that the number of people who died from wars between the 90s and 2022 fell dramatically. If you look at the Uppsala or the Oslo Institute of Peace, which covers the data, in the 60s, 70s, 80s, up to the 90s, between 100,000 to 200,000 people died of war. And this is just conflict, civilians and combatants, not the sort of famine, disease that accompanies, just from conflict. 100 to 200,000 people dying on average every year. 90s to 2021 dropped to below 100,000, and between 2000 and 2010, below 50,000. So again, I'm not going to make grand claims of causation or correlation, but during this golden period of globalization, less people actually died from war. And that is just 2 facts. I'm not saying one caused the other. It's a fact. It's also a possibility that we can go into a future where less people are dying. 2022, 200,000 people again. And so my worry is that not only are we going into a period of deglobalization from an economic perspective, from a human perspective, having 2 major wars and several others are just not good for humanity. Again, I'm sorry, I veered off topic. We're not seeing deglobalization, is the one-line answer to your question. We're seeing trade actually grow every year since that term became in vogue. However, between 2010 and 2019, trade in goods and services grew at about 4.5% annually. Last year, it was 1%. Now you'll say, was that deglobalization? We don't think it's deglobalization, it's growth. Growth is the thing that correlates with trade much more than anything else. And last year, Germany and China not growing, firing on all cylinders, big traders. So that sort of, slowed down growth a little bit. Again, people moved from post-pandemic goods consumption to services. And of course, goods are the bigger trade. So we saw that sort of slowdown. But what else did we see? movement of people, if you think about globalization as not just goods, people continued, migration was back up after a drop in 2020. Legal migration and of course, not legal migration was up. Investment flows, again, continued to go up. What else? Sort of services, and the big sort of bucking of the trend, digital services growing immensely, high single digits, double digits in some cases. Very small number of nations trading in digital services, and by digital I mean software to Netflix, to everything in between, growing very rapidly, data being, so we're not seeing deglobalization. What we are seeing is, yes, those that are trading with each other are perhaps changing, and you're seeing a little bit more of the friendshoring. But if you think about it, China produces about a third of manufacturing in the world. You cannot just cut it off. I mean, if that is one of the things that drove the US-China trade relationship, you can't cut China off. It produces a third. In fact, US intermediate goods imports from China have been increasing. So final goods not increasing, but intermediate has been increasing. So in that, our sense is that, yes, you'll see the way supply chains move changing a lot. But will countries continue to trade with each other? Absolutely. Will there be a second derivative of people, investment flows continuing? Absolutely.
You mentioned several things in factors contributing to the growth in trade, such as growth in technology. You said digital services. Was that the term you used?
Yes.
Okay. I want to use that to segue into a question on artificial intelligence. It's the thing everyone's talking about or not thinking about. We know it's a disruptor. Can you share your thoughts on how that might be contributing to kind of, one, a growth in globalization, a growth in a global economic interconnectedness, but also just the growth of AI as an economic sector and how that's impacting the year we look ahead to?
Yeah, sure. Can I do another audience poll very quickly?
Please.
I'd love to hear from the audience in terms of artificial intelligence. And this was sort of, it's a false sort of dichotomy, but I'm going to express it anyway. Net good for the world, or net it's going in terrible directions in the future and we don't know what robots are taking us over. So can I get a show of hands? Net positive, net negative.
Positive, clearly.
Clearly, there you have your
an
answer.
optimistic audience today.
I know. And I have to say, I tend to believe in the audience's answer, but I will address yours, because I do think that, like any technology, the disruption will come, and there will be people and companies and countries that will suffer greatly and deeply. And we mustn't lose sight of that. Every technology that has come from the Industrial Revolution to the internet to AI has created, and thankfully, far more winners than losers. But we, as a society and as policymakers, have not always been very good at mitigating the loss. So I will preface with that. But then how are we thinking about it? And I go back to sort of our role in the world. Our knitting is to sort of really analyze, what does this mean for credit risk? And we see it in a couple of ways. So one clear thing that AI does is it can affect the revenues of some sectors, and it's the software sector that wins. It's chips producers that win. It's those commodity producers that are producing the things that chip producers need that win, thanks to AI, because it just uses, and AI is coming, by the way, at the same time that digital ledger technology, beyond crypto, DLT is growing. All of these things require a lot more in hard commodities as well. So I think, we looked at it from a revenue perspective. We then looked at it from a cost perspective, and we do think that there's a much wider range of industries and including governments that can deploy AI, because to your point about aging populations, AI is coming just as labor forces are shrinking, so you can offset your labor force, which is costing more and more, and should because it's more scarce, with AI for routine tasks, which are not that great anyway, so let AI do that. So that I think is something that's positive from a bottom line perspective, efficiency gains. That's how we're looking at it. The way that we look at it from a debt perspective is how much you have to invest to really get that revenue gain and that efficiency gain. The answer is a lot. Mm-hmm. And so it might be that the bigger companies who have the credit profile, who have the capital, who have already market share, brand, will win relative to others. That could be one way of looking at it. And that may be true in the applicant sectors, so in, say, healthcare or in pharmaceuticals, where you're sort of taking the technology and applying it. But there may be other services sectors, tech sectors, where the startups, which are really nimble, not afraid to fail, able to create products more easily. I mean, OpenAI came from a small company, was bought up by a large company. So you might see a proliferation. And that may finally be good for society. You want to see new firms come in. So we generally see it as positive. But two things I'll say. From a macro perspective, you won't see the gains in the very near term. So those of you who follow economic data will know that last year, US productivity growth was much higher than it has been in sort of the decade before. And also was the year that ChatGPT was introduced, so you could again make a false sort of correlation and say, but no, the productivity growth was sort of your usual late cycle productivity growth, that when costs start rising as they did, companies start becoming just better and better at using their resources more efficiently, and we saw productivity growth. We're not going to see it at the macro level. Micro level, we're already seeing it in so many ways.
If I could ask a follow-up related to AI but unrelated to the topic, how is the technology impacting your work at Moody's and your team's work, and how you're assessing risks and making these calculations?
Oh, that's a really good question. So we rolled out a product called Research Assistant at Moody's. And one of the things that we do, I mean, we rate these companies, we write a lot of research explaining our assumptions and sort of our views on these companies and governments. And we have an AI-driven product that helps you. Sort of you go to the website and you say, what does Moody's think about sector X or a country Y? It'll aggregate all of that. And it's new. So, it'll, I'm sure, evolve over time. So that's one way in which we have already deployed it in conjunction with Microsoft. The second, we are a company that, we believe what we do is frightfully important. And before we bring in any changes to it, especially technology-driven changes, we like to test these things out quite completely. So we're still testing, so we're not actually using it in the ratings process. But are we actively looking at how AI can increase efficiency? Absolutely. We have a very quantitative team in my world, and they've already, machine learning before generative AI was already something that modelers use and is sort of an acceptable technology. So we are sort of, deploying it. But I would say that we are among the companies that want to make sure that we don't sort of adapt this so quickly that we lead to errors in our output. And we're aware of that, so we're not using it that way.
That's so important. Any company looking at AI, the risk of errors, I think, is something we don't know yet. And
yes.
So as we take on these technologies, there's always a fine line to walk between embracing versus the risks there. I'd like to pivot a bit. So we're here today to talk about a year of risk, and I think the elephant in the room is maybe the upcoming year political risk in the U.S., specifically the race for the White House. I'm not going to ask you to pontificate on any candidate or make predictions there, but thinking of the question differently, what do you think is important for the winner of that race, regardless of who it is, to keep in mind based on everything we've discussed and what you're thinking about?
I had to sip water before handling that one. But I'll sort of preface it by saying, again, I'll sort of answer your question from our perspective, which is the economy and the credit profile of the United States. And I'll preface it by saying a couple of things. A, we rate a lot of over 130 countries around the world, and we found that elections per se don't change the credit profiles of these countries immediately. What they can do, they can change credit profiles of particular sectors or particularly government-owned enterprises when you have an election and party comes in that believes one thing or another. So it can create credit risk, but not for the sovereign themselves immediately, but for others. So that's one thing I will say. This is a general observation. The second observation is sort of more general about the United States. That, I mean, and again, this audience knows in the year that the 3 years that we've had, the U.S. has stood out for its ability to actually respond very quickly to the policy implications of pandemic with fiscal stimulus, particularly monetary stimulus. Again, sort of take action and address things. So that's number one. The U.S. economy has proved itself very resilient. If you compare U.S. performance last year to say Europe or China, did very well despite those very high interest rates. And there is something to the sort of the dynamism and the institutions that make it so. So with that, the question for the next administration, and not just the administration, it's Congress as well. And it's also, again, to your point about climate and things like that, local level elections is, are political leaders and policymakers going to be able to maintain this incredible and really unique economic strength that the U.S. enjoys in the world? To do that, one, you have to address fiscal policy, I think. This is a country where the aging population is going to lead to higher costs from the fiscal. And that is something that neither party has really shown an appetite for addressing. And rightfully so. These are important things that affect human beings who are also voters. So it's hard to address. But if debt continues to grow, and the U.S. can afford to sort of sustain its debt, but as debt continues to grow, it becomes harder to respond to shocks like pandemics and wars and what have you that come up. So that fiscal is one thing that we'll be watching because we're credit risk analysts. So fiscal is very important to us. The other thing that we'll be watching again is sort of, the addressing of climate and carbon transition risks for different reasons, for different jurisdictions. I mean, if you're covering Florida, our analysts for Florida or for California, they'll be watching these things as well. And then the last thing I will say, you asked about deglobalization and sort of U.S. engagement with the world. I think it's pretty clear. But people who come to the Asia Society really recognize the benefits of engaging with the world, I think. And we certainly see that. And I think the next administration and how it chooses to engage with the world will be important not just for the world, but for the U.S. as well. Because the U.S. gets many, many benefits by being sort of a leader in the world. So I would point to those three: fiscal, climate, and economics in general, and then sort of engagement with the world.
So you made a very good point that a change in administration doesn't necessarily change the credit profile of a country, but specific sectors can change depending on who wins or loses. Looking at either candidate, are there sectors that stand out to you that might, rise or diminish depending on the outcome?
And I'm not trying to prevaricate or not answer your question, but neither candidate has, or party, because the parties sort of provide platforms. Until the summer, we won't know what the platforms are. So we don't really have a sense of the policies. But if you think, and again, the candidates we'll wait till the party actually nominates them to speak of a candidate. But the last administration, so the current one, the Biden administration, has really focused on that adapting to structural shifts in their regulatory and their policy focus. If you think of the antitrust sort of stuff that they've done, the work that, again, and this is not the administration, but it's sort of, the SEC's focus, the way that, again, the IRA, the Infrastructure Act, the CHIPS Act, it has, very, very much focused on how the U.S. adapts to climate, technology, and a changing global environment, very focused on that. I think the prior administration, the Trump administration, also focused on that, just in a very different way, very focused on trade and how the U.S. engages with the world and sort of doing it on what they would describe as their own terms. So I think both address some of these long-term things just in very different ways. And I will say one commonality, though, is the stance towards China. You could say that when the Trump administration was in office, lots more tariffs, lots more restrictions on China than before the Trump administration. over the course of the Biden administration, those have grown. They've not reduced. So that's one area where both administrations and Congress, by the way, seems to believe that that's the way to go. And I think that for the world is going to be an issue. Small anecdote, if I could. Just this morning on the train, I was reading the Financial Times, and the headline says, the head of Mercedes-Benz urges the European Union to not increase tariffs on electric vehicles from China. Why is a German manufacturer saying don't increase tariffs on electric vehicles from China? And he sort of makes the case that, look, you can't grow with protectionism. You have to grow with open competition. Let them come and let us compete on a level playing field. The article also goes on to tell you that 1 in 3 cars that Mercedes-Benz makes is sold in China. And retaliatory tariffs are a thing. A good amount of Volkswagen's cars are sold in China. So I do think that, the unanticipated impact of policies play out over time and are not. So, I will say my corollary to the point I made earlier is that it doesn't affect the credit profile immediately, but over time it sure does.
Fascinating. I would love to turn it over to questions, so we have plenty of time for that. Anyone in the audience have anything? Go ahead.
Yeah, you mentioned of the 4 factors.
Oh, 1 second. Give us time to get you a mic. Perfect.
Of the 4 factors that you mentioned at the outset, it would seem that polarization either underlies or will affect the other 3. My question is, what is your view of the capacity of polarization to increase risk perception or risk potential and therefore global valuations?
It's a good question. And the way, again, we think about polarization is how, from our perspective, and it does affect risk perception, is how it affects institutional operation. And what we are seeing is that in the United States, you could argue it's a very polarized time in this country. We've had periods of extreme polarization. There are historians amongst us who will tell us that, far worse than what we're seeing now. What we have seen, despite that, is that the Federal Reserve continues to do its job and is, I would say, doing it well. There was this time when people were talking about inflation and the Fed sort of not, raising rates fast enough. And we can have sort of a discussion on that. But in the end, the Fed raised rates and inflation has come down by 600 basis points from peak without unemployment going up. I mean, it's gone up a little bit now, but less than 100 bips increase in unemployment with inflation coming down by 600 basis points. When was the last time that happened? Not in the United States ever, since we started keeping the data. So, you could say that the institutions that affect risk perception are working well. Treasury market, you remember that there was a wobble. This is something we follow, and maybe it's a little bit in the weeds, but the Treasury market operation, again, you had regulators from the Fed, the SEC, and others coming together to make sure that that was addressed. So I think in some sense that is a sign that the institutions are working despite polarization. The big test is always the debt ceiling debate. And I know you've been in politics, so you know that it seems like the two parties like to get closer and closer to the deadline every year. But look at where the markets were during that time in June, when we were literally, I think, weeks away from sort of the deadline. Markets didn't move because the risk, I think they sort of priced in that it's even these two parties that don't get along at all, with all that happened with the speaker, the leadership votes, etc., they'll come up with a solution, and they did. So I will say that in the U.S., the polarization is again not leading to. Similarly, in Asia, I would say that we're not seeing the same kind of very sort of verbal and sort of social media type of polarization. There is polarization, but we're not seeing it come out in ways that has Asia still fastest growing region in the world. So we are actually, people I think are able to distinguish between the kind of polarization that leads to bad outcomes in a localized, in a particular issue, and very broad bad outcomes so far.
Hello. Would you mind share your view about China stock market and what's the biggest risk to the China economy
Yeah.
in this year and the following couple years? Thank you.
Certainly. And if I may, I'm not a stock market expert, but I will tell you what I think about the fundamentals that drive stock market valuations, because the valuations will go up and down as they do. And I think what's currently being reflected in the valuations are three things, which I think fundamentally are issues that could arrest China's medium-term growth. The first is the property market shock that you saw in China, and that's a real thing. And the reason property markets are important in any country is that households tend to invest in them. And once you have household wealth come down, that affects consumption, that affects then investment, that affects sort of overall working of the economy. So anytime, people are what ultimately drives the economy, and people are what economies should serve. So property sector downturn is sort of an issue. And corollary to that, in the past, China has had property sector downturns, but each time these have really threatened growth, the Chinese leadership, because they have the wherewithal, has infused capital into the economy and sort of buoyed the economy back again and buoyed the property sector again. This time, it is our reading that the leadership in China does not want the economy to become too dependent on the property sector. It accounted for almost 20% of GDP. That's a lot for one sector to carry, especially if it's becoming less and less viable. And there's just so many houses people can buy. So property downturn is a real thing. We do think that that property sector is going to shrink its share of the economy, and the leadership is aware of that. And they seem so far to be willing to let it without boosting the economy and creating pockets of leverage and bubbles. So that's one. The second is the local governments in China. They have been the engines of investment growth in China, and that has again been fueled by debt. Again, the leadership in China sort of recognizes that given demographics, given where the Chinese economy is in its growth rate, this was an economy that grew at 10% when it was a $6 trillion economy. It grew at 7 to 8% as an $11 trillion economy. $20 trillion economy is going to grow slower, and you can't keep building up leverage at that same pace as your growth slows down. So local governments, LGFV is another issue, and that I think is something that's on the minds of people, that where will growth come from if not these two engines of growth? And then the last thing is sort of demographics, and we know this, that China is aging, and the social security system there isn't a safety net. At the same time, China has more millennials than we have people in the United States. So the quantum of young people who need work is still very large, and the provision of that work is not easy. So I think that's sort of the third thing that the stock market is recognizing. Taking all these three things together, we're projecting a growth rate of around 4% in China over the medium term, which is not bad, again, for an economy that size, but perhaps not enough to fulfill the sort of economic and social aspirations of the people. And I think the stock market is pricing that in. Having said that, number one EV producer, exporter in the world. Patents, China's got them. 30% of the world's manufacturing. This is still, in terms of the new economy of carbon transition and renewable energy, China's a leading player. Technology, both from AI, digitalization, China's a leading player. So you would write off the economy at your peril. There is still a lot there that could boost growth. It's just not in evidence at this particular time, so we do expect a slowdown. But 4% growth is still not bad.
Lots of hands. Great. In front here.
Thank you. To follow up with that question, how about the exterior factors to the Chinese first economy, second the stock market? Thank you.
Yeah. And thank you for raising that. It's so interesting that both the U.S. and China, they are the sort of biggest drivers of global trade. But in the US case, particularly, if you look at trade as a percentage of GDP, it's quite small because the economy is so big that even if we trade a lot, it's quite small. In China, it's not the case. Trade is a big part of the economy. So it matters that China is facing sanctions, tariffs, and investment restrictions, not just from the US, but from US allies, including in Asia, and from Europe. So that is an issue, and I think that has played into a sentiment downshift, which is also being reflected in the stock market. I would say that China's reliance on exports eroded a long time ago, and it became much more reliant on investment growth than exports. To me, still, the risk in China, or the issue, and I say this as somebody trained in economics, that it is really rare and actually unique for an economy of this size to have consumption be such a limited driver of growth, that it's under 50%. No economy of this size has reached this size without consumption spurring it to this degree. And so to me, it is the consumer sentiment, and there's an economist called Adam Posen who calls it long COVID for the consumer in China. And he says, it just feels like sentiment never picked back up after COVID in China. And perhaps some of this external stuff is driving that sentiment too. But I do tend to think that the domestic problems are sort of quite weighty, and the external stuff is additive to that. I will say that China sort of, has done a few things like the Belt and Road, which sort of projecting power abroad, trying to sort of expand. And there's been mixed results to that, sort of mixed feedback there. But again, this is still a country that invests a lot. And we're seeing, again, Vietnam, Malaysia sort of benefiting from people sort of moving offshore from China. But they're not really moving away from China. They're simply doing China plus one. So that external isn't a complete cutoff. It's simply a diversification. So we tend not to weigh it as a key driver of the slowdown in China.
Thanks for speaking to us. About 10 years ago, when rates were really low, a lot of countries and companies, everyone borrowed a lot of money. A lot of maturity walls are, in theory, going to hit in the next 5 years across the spectrum. Do you see that being a big risk for any piece of any type of borrower?
Yes, thank you for asking, because this is my bread and butter. So I get to throw some default data at you. So if you think about it in country terms, you used to have, in sort of a 10-year period, 1 or 2 defaults per year. Since the pandemic, that number has been 6, 7 countries. And there's only 200 countries in the world. So 6, 7 is large. So we have seen the countries that have defaulted have tended to be lower rated. So countries that we had rated B and below, they tended to be smaller. They tended to have borrowed abroad in currencies other than their own, and then had a big shock to their export revenues. And that sort of twin shock of borrowing abroad, having a shock to your revenues, and then seeing your refinancing costs rise, that's what we saw at the country level. At the company level as well, so the long-term average of default rates is about 4% globally. In the global financial crisis, that rose to about 13%. During the pandemic, close to 7%. Why was it lower in the pandemic, even though growth fell more? Because the Fed infused a lot of liquidity and the government infused a lot of liquidity, and people around the world did the same thing. We are now seeing that default rate at about 5%, so above the long-term average. And we've not seen it at 5% absent a recession in the US before. And what that's telling you is that the rates are biting. And again, the average rating of the issuer that has defaulted on their debt is CAA1. So again, smaller companies, highly leveraged companies with business models with volatile revenues are the ones that suffered the most. So we are seeing that bite.
More questions around that one?
Thanks. So the first 2 questions. The first one is somewhat related to the previous question, and that's where do you think we're in the credit cycle, and do you see in particular, do you see the risk of sort of global deleveraging? And then 2 is, what is your view on private credit, and where do you see that going forward?
Sure. Again, thank you. We've been talking a lot about both things. So on where are we in the global credit cycle? There are people who say that the pandemic has sort of messed up the way we analyze credit cycles, because you saw such a shock to employment and such a positive shock to liquidity in the same year, and that has thrown things out of whack. And I subscribe to that, but I would go one step further, and I would say that if you think about the credit cycle the way we all did in the 90s or the 80s, the low rate era also has sort of weirded out the cycle, if I could. And that, I think if you think about it, before the pandemic, we had the longest expansion in US history on record, partly because of low rates and partly because we were able to ride out things like commodity shocks that happened in 2015, 16, et cetera. Lots of things that happened we were able to ride out because of the lower rates. So to answer your question, we think that we are sort of in the trough year this year. So growth last year we had projected, and I don't do these projections, somebody on my team does, 2.4% last year, and came in at 2.5. We're very proud. And so, fairly robust growth last year. This year, we think that it'll come down to around 2%. So again, some might call that a soft landing. We don't give it any names. But that's not bad for your trough growth rate. And then we think it will pick up again next year. So that's on growth, and that's in the US. In the rest of the world, the cycle is different. Europe had a trough year last year. So Germany, sort of slightly different. UK, things are going, not going. The thing I will say about Europe is they had that year while having an energy shock, which they seem to have addressed pretty well, while having rates that were that high, while having, the current situation in the Red Sea affects Europe. The supply chains that are worst hit are European. So given all the shocks that Europe had, not too badly. And I would say, again, same thing. We think this might be a trough year and back up again. Emerging markets, again, varied. India seems to be doing very well. China, 4% this year. So I'll stop there on that. Private credit. People sort of, I think it's sort of in everybody's minds. And it's a product of a couple of things, right, structurally. One structural change was the regulation that was put in post the financial crisis on banks, and what that meant for the way banks lent to the riskier corporate credit, so the smaller enterprises, which would have gone to the banks at some point, and then the lower rates, which allowed sort of private equity to grow and get deeper and deeper into the credit risk profile and sort of lend to smaller companies that may not have accessed markets before. Our sense is that this is a growth market, and it will continue to grow because it has a role to play in the financial sector. You have banks that are lending in a particular way. You have the syndicated loan market that lends in a particular way. And you have a bond market that sort of lends, again, to slightly higher rated, bigger companies. Private credit sort of occupies a space between it. We do think that last year, what we saw was the syndicated loan market and the bond market kind of close off for the riskier borrowers, because you have not seen 500 basis point increase in rates over a one-year period before, while at the same time your revenues are not growing that much. And so that market was shut off. And private credit had all this dry powder, which they were able to deploy because they anticipated there would be an upturn. That probably you won't see repeating, that space that opened up for the private credit sector. That's number one. Number two, not been tested in a higher rates environment, both their portfolio and how it'll perform in a higher rate environment, and also the inflows and how they will perform. So there is that, but we do believe it will grow.
We had one more question in the back there.
Thank you once again. This has been very interesting. Maybe kind of a tag along to point or risk number 3, but amongst your team, when you were compiling the risk for the year, what were the most contentious points, or what were you debating most fiercely internally for either the implications or to be a part of those 4 key drivers? Yeah,
that's a very good question, because, my goodness, do we have debates. And one of the things that I say about AI, and I say this in jest, so please don't repeat it as if it's serious, is that if we deployed AI, who would argue with whom? Like that is so important in what we do, that we come up with, we think the right answers because somebody will yell at you about how you're wrong before we go out with any answer. And I will say that the near-term one was the most contentious. So it was recession, no recession, with some people. And it's interesting what sector you come from. So if in 2023, you were an analyst that covered banks that had invested heavily in commercial real estate, you were a lot more pessimistic than, say, somebody who was the rating analyst for NVIDIA, or Google or Apple. So their views were different. And luckily, we have a very sage macroeconomist who was really Solomon come to judgment. And she made the call for, and she has a very complex model, of course, to help her to say, but that was, recession, no recession. And similarly, we're having internal debates. Our view is that the Fed will cut rates by mid-year, but of course there are individuals that are seeing reasons why they might not. But our house view is that.
We have time for two more. Start here. 1 second. Give us a second. I'll give you a mic. Thank you.
You mentioned the Red Sea, and that was the first mention of sort of conflict risk, either existing conflict or potential conflict. I talk to people who sometimes spend a lot of time looking at potential conflict risks in Asia, Taiwan, South China Sea, North Korea. How big a factor is that for your analysis?
Thank you. That's a very good question. So again, our baseline is that sort of a military-style conflict in the Taiwan Straits or in the South China Sea, and beyond what we've already seen in the South China Sea with the sort of saber rattling, that our baseline is that is unlikely. However, it behooves us to run scenarios and say, hey, what if an unlikely event occurred? Because they do. See pandemic. And our sense is that anything that happened in the Taiwan Straits would, of course, affect the chip sector and semiconductor sector immediately from a sentiment and a real perspective, but it would have far-reaching consequences around the globe. So something there, because just the amount of commerce that goes on in China and Taiwan, that would be a global issue. And we compare that to what's happened after Russia, Ukraine, and Israel, Hamas, where particularly Russia-Ukraine, you did see sort of oil prices go up a little bit. The food sector did suffer, and sadly, that affects real human beings around the world, especially those who have least access to it. But once Israel-Hamas, you see markets. I don't like to use the word sanguine, but markets were sanguine. Didn't. And I will say because the energy market, and actual energy, is the prime transmitter of credit risk from a Middle East conflict to the broader world. And the United States today, compared to 10 years ago, is energy independent. And that has been a big, big change, and that's why. And even exports energy. Same with Europe, that Europe has found ways, including, countries sort of taking energy from Russia too, to sort of mitigate the energy. So the way we discuss conflict is what is the impact on the things that matter for credit risk? And we find that, Taiwan would be a bigger issue than we've seen actually Russia, Ukraine, or Israel must be. But I come back to that statistic on the number of people killed. And that's no small thing. So already 2022, we're back to where we were in the 80s in terms of number of people killed in conflict.
Let's do one more, and then we're at time. So this will be the last one.
Asti, thank you very much for your comments on various reasons this morning. And I'm interested in hearing more about the Middle East. There's a growing importance in Middle East, and we see American companies investing in countries like Saudi Arabia. So I'd love to hear your views on Middle East.
Yeah, and I would say, and thank you for that question, because one of the things that has come home to me about the Middle East is indeed, we are hearing a lot more from investors interested in our views on the Middle East, but a lot more activity in the Middle East as well. And I would say, I think I mentioned earlier that policy plays such a big role. And I do believe that in the Middle East, well-coffered governments took a policy decision to diversify their economies. And you know, Dubai has been doing this and the UAE has been doing it for some time. But you've seen Saudi Arabia have a real plan. And that matters. And a few things about this diversification. One is global. You had asked a question about sort of global implications. The kind of acquisitions that the wealth funds have made in the rest of the world are just tremendous. And I was listening to one of those Bloomberg podcasts where there was a commercial property developer sort of, you know, on the podcast, and we're talking about CRE. And he was making the case for why he wasn't very worried about his property portfolio. And he said, well, because, you know, we've been talking to our friends over in the sovereign wealth funds in the Middle East, and they're very interested. And the podcaster said, oh, I wish all of us had, you know, friends in the sovereign wealth funds in the Middle East to sort of invest. But I think that was a case in point that the diversification from commercial real estate to sports teams to, you know, all kinds of stuff abroad, but also within, and particularly in renewables, a lot going on there. So we are seeing sort of a lot of activity. In fact, and you had asked about private credit, our global head of private credit was recently in the Middle East talking to people there who are interested in sort of alternative asset investment. So we're seeing both financial investment come out of the Middle East, which makes them interesting to people outside because they see sort of the economic power there, but also the investment opportunities that Middle East governments have created for real investment in renewables, tourism, technology, you know, digitalization, very big. That's what we're hearing at a very high level.
Amazing. Well, we're unfortunately at time, so I want to thank you all for joining us today, and then, of course, thank Dr. Sheth for joining us today and sharing her incredible wisdom and looking at the risks a year ahead, both optimistic and some things to worry about, but a lot to learn. Thank you.
Thank you so much for moderating, and thank you all. I learned so much from your questions.